Now, let's switch gears altogether, and we're going to talk about creating the budget, which is where all things begin in financial management in a nonprofit. So, silly question, what is a budget? Well, everybody knows what a budget is. It's got a spreadsheet, it's got lists, it's got numbers on it. But in reality, the budget is an annual plan. It's a plan consisting of numbers, but it is a plan. And it's a plan that says what your organization is planning for, what is going to happen in the year ahead, what it will cost, and where that money is going to come from. When you're making your budget, you are planning what services will be provided. They may be the same, they may increase, they may decrease, they may be new ones, but you are planning what services you will provide, and you're deciding what these services are going to require in resources. That's staff, that's space, that's IT, whatever it is, services need resources. And then you're deciding what it's going to cost to support these resources to run the program. And you're deciding where the money will come from. When you have completed a good budget, you know for the whole year ahead what you're going to be doing, what it's going to cost to do it, and how you're going to pay for it. Now, budgets are an annual plan. However, the fiscal year of an organization may very well vary. It could run from January to December, which is a calendar year. It could run from July to June, which is the state fiscal year. It might run from October through September, the federal fiscal year, but regardless, it is a 12-month plan with a start and end date. Now, any organization that has more than one program is going to need a budget for each program. It will also need to budget where all the managerial and the support functions are going to come from. And together, the total of all the program budgets, the managerial and support budgets will total into the full organizational budget. So here is the simplest possible view of a program budget. It begins with revenue, each of the different types of revenue, and a total, and then it lists all the expenses. Always start with personnel because it's usually the biggest, then all the other expenses, and together, total revenue minus total expenses is the balance. That's a budget in a nutshell. So let's talk a little bit about revenue. There's only a certain number of types of revenue that a nonprofit can get. There's charitable donations. These can be corporate foundations, individuals, fundraising events. There's government revenue, contracts, vouchers, etc. Could be municipal level, state level, or federal level, or even an international body. There's earned revenue. Nonprofits can earn revenue. It might be membership, it might be program fees. Large institutions like Northeastern are earning revenue from your tuition. Major hospitals earn revenue from insurance payments. A nonprofit that's fortunate enough to have an endowment can take the revenue earned in interest from the endowment as revenue, and there may very well be other sources of revenue as well. On the spreadsheet, it's going to, on the program budget spreadsheet, it's going to look like this. You'll see government revenue, but again, these are the totals. You need to be working on separate spreadsheets to plan for all the types of government funding you reasonably expect to get, and that total will be on the government line. Same for donations. You list out all of the donations, you reasonably believe you can get, and that total will fall on the donation line. People usually budget a fundraising event separately because they're going to be budgeting the expenses for that event separately. Again, your endowment may be earning interest. Earned revenue, again, you're going to be calculating separately how you plan to earn the revenue, how many units of membership or program tickets, etc., that you expect to bring in the year, and that figure total is earned revenue as well as other. Combined, you have now determined a reasonably expected total revenue for the year. So let's look at expenses. The biggest expense almost all nonprofits have is personnel. And personnel costs are going to consist of staff salaries, and that's both hourly and salaried staff, and we'll go into that soon. Payroll taxes, unemployment insurance, and benefits. So, what is salaried versus hourly staff? Well, very simply, hourly staff are those who must be paid overtime, which is time and a half, 1.5 times their hourly rate for all hours over 40 hours in a week. While salaried staff, also known as exempt because they're exempt from the overtime rule, do not necessarily have to be paid overtime, but companies will typically pay them more and offer more time off or other benefits. So, how are you going to decide who's salary and who's hourly? Well, you don't. The Fair Labor Standards Act determines what staff are hourly and what are salaried, and they are very, very particular. So, a salary position that does not have to be paid overtime. One, it's someone who regularly will be supervising 2 or more employees, and or has management as the primary duty of the position, not just its title, but who actually is managing, and usually has some kind of genuine input into the job status of other employees, which is a lot like supervision, hiring, firing, promotions, job assignments. But it's also going to consider, does this position directly relate to management in the general business? Does this position ask that the person use independent judgment, make decisions that matter about important, significant issues? Or thinking more like a professor or a scientist, is this position primarily intellectual? Did it require a high specialized education? And is it mostly using judgment or discretionary functions? In addition, and this is very recent and interesting, as of only in the last year or two, salaried employees must now earn a minimum of $35,568 annually. And this ruling was put in because it was finally acknowledged that many fast food chains, retail establishments were calling their managers or assistant managers salaried. They were working all kinds of hours. They did have these responsibilities, but they were making practically minimum wage. So finally, if in addition to the responsibilities, salaried employees must also now earn a minimum annual salary, and it's high time. Yes, nonprofits do have to pay payroll taxes, the largest of which is FICA, which is a combination of Social Security and Medicare. And as you can see, that's calculated per employee as percentages of that person's salary, annual or hourly. A nonprofit also has to pay unemployment insurance, but this is a rate set by the state. However, nonprofits can choose to purchase private unemployment insurance instead. Benefits are going to include health insurance, that's the big one, life insurance, short and long-term disability, hopefully a retirement plan, and there may well be other benefits such as tuition reimbursement, free parking, etc. Typically, when planning the budget, a nonprofit is just going to calculate, for the purposes of budgeting, a total figure for benefits as some percentage of salary, which is generally 30% of salary, again, is going to be benefits. So you can see it's a hefty piece of your budget. Then there's all the other expenses that most nonprofit programs and organizations are going to incur. They have to pay rent, or if they own a building, there's all sorts of maintenance and facility fees. They have to pay utilities. They have phone. They have IT expenses. They need supplies. They need equipment, printing and copying, travel and transportation, fundraising, marketing, etc. And here is just the picture of what the expenses portion of a budget is typically going to look like. You'll start with personnel, you add your salaries, payroll taxes and benefits, and you'll have a subtotal for total personnel. Then you have all your other expenses, which will in time total other expenses. And finally, total expenses are a combination of total personnel plus total other. And at the bottom of your budget is the balance, and that's simply total revenue minus total expenses. Now, generally, your balance should equal 0, or it better be a positive number. However, some large organizations, and the YMCAs in particular use this, will budget specific programs to run a deficit. For instance, they will have branches in low-income communities that they expect will run a deficit every year, while their branches in wealthier, high-end communities are budgeted to run a surplus to help support the low-income communities, which I think is a very progressive way for a large organization to function. Now, another thing to think about when thinking about expenses is the concept of direct and indirect costs. An organization that provides services has certain expenses that are necessary to provide these services, and they're called direct expenses. A program could not function without these direct expenses. However, there are other expenses that support, that enable these services to happen, and they're called indirect expenses, or overhead. But then there's indirect expenses. Simply everything else. Everything that's not direct is an indirect expense. This is also going to be called overhead or administrative expenses. An organization has to have some kind of management. It's got to have someone doing its fiscal controls. It probably has to have fundraising at a certain size. It's got to have human resources. It has to have marketing, IT, etc. And all of these indirect personnel have to have space to work, supplies, phones, IT, which are also indirect expenses. So if an organization only consists of one program, well, that's easy. You can just put everything into that one program. But most often, an organization has multiple programs or multiple sites. The direct charges are easily linked to each specific program and their services. But the indirect charges, which are necessary but not linked to any one program, these have to be shared across each of the programs. So organization with 5 different programs, the management, the fundraising, the marketing, etc., all 5 programs have to share these expenses. So let's say we have a neighborhood multi-service center, and in its facility it has a senior lunch program, a childcare services, evening classes for ESL, and a teen mentoring program. What a great place. Now, the multi-service center is renting the building and it's paying the utilities. This organization has a CEO, an operations coordinator, an accountant, and some accounting support staff, fundraiser and some fundraising staff, volunteer coordinator, administrative support, and they all have office space, phones, ITs, etc. So how are these 4 direct programs, the lunch program, childcare, ESL, and teen mentoring, going to share the costs of the building and share the costs of all these indirect services? So they're shared across each program, and there are several accepted ways to do this. In other words, to calculate an indirect cost rate, which means what percentage of these costs will each program have to carry. A percentage is assigned to each program, but to come up with that percentage, one way to look at it is for each program, what percentage of total personnel does that program have, i.e., how many staff does that program have, and what is it a percentage of how many of the total organization staff? Or it could be a percentage of expenses. If an organization has, say, 25% of the total organization's expenses are that one program, that's another rate. Or it could be likewise a percentage of revenue. What percentage does this program's revenue, how does that compare to total organization revenue? Now, for federal contracts, sometimes the federal government will set its own indirect cost rate, and I can guarantee you it's never enough. So very simply, once an organization has calculated what its indirect cost rate will be using one of these different models, each program will multiply its costs by the indirect rate, and it's typically somewhere about 15% is safe. And this new figure is going to be an additional line on the program's budget, a new expense line that's now called indirect. So here is our standard budget for expenses once again, but you'll notice there's a new line on it now before totaling called indirect. And this consists of adding total personnel and total other expenses, and then multiplying that by 15% or 0.15, and then that is going to be added to total personnel, total other, and the indirect will now total together your total expenses for your program. So why does this matter so much? Well, when you're a funder, you like to think that your funds are going directly to the provision of services. If I donate to that multi-service center, I want to picture my money helping seniors have nutritious meals or helping teens sit with a mentor. But if I'm at all a savvy donor, I have to know that this multi-service center must have a strong infrastructure in place to manage all these services. And these indirect costs are necessary in order to know that this multi-service center is going to be using my money most efficiently, meeting its missions in the best way possible. In addition, be aware that indirect costs, and especially the salaries and benefits of senior managers, will be very carefully scrutinized. So, let's take a look at a few best practices in budgeting as we conclude. For starters, when you're budgeting revenue, be conservative, which means how certain are you of this revenue? Why do you expect that this revenue will come in? That doesn't mean you have to have a signed contract or promissory note, but you have to look at the history of government contracts, the history with your donors, what you've been told to expect, what has been happening among your peers, and ask yourself, how likely is it? Why do I believe that this amount will likely come in? For a fundraising event, you can certainly ask yourself, what's the history? Is the economy, are my biggest donors doing well or not in the next year? The same for earned revenue. What has been the pattern? Why do I expect this? You do not want to add revenue that you have little or no idea where it's going to come from, that you just hope somebody will be nice to you, because if they're not, you're in a real problem. On the other hand, when budgeting next year's expenses, expect the unexpected. And caveat here, I am not going to talk about how to budget for a pandemic, another COVID-19. I don't know that anybody knows how to budget or plan for this. But let's talk about returning to the new normal and how to budget the typical, normal, unexpected items. And that might be a sudden flu, not a pandemic, but a bunch of staff go out and you have to hire a bunch of relief staff. Or you may have staff vacancies. Now that's going to save some money, but it may cost even more to hire temporaries. Utilities may be affected by a sudden severe winter. Equipment that should have been lasting suddenly needs to get repaired or replaced. In other words, things are going to happen, and you're better off, painful as it is during budget time, to add some expense to cushion you for these. So if you are budgeting your revenue carefully, a little conservatively, if you're budgeting your expenses with some cushion for the unexpected, you can feel very confident when presenting your budget that it will guide your organization and your programs comfortably through the next 12 months, allowing you to do the work that you are there to do and accomplish what you hope to accomplish while staying fiscally sound.